Is it too late to buy Warner Brother Discovery stock right now? It's already up over 60% year to date in 2023. Of course, the company is home to some popular franchises, including Harry Potter and Game of Thrones. However, will that be enough to make the stock a buy? I'll answer that question in this video, so let's get right into it. The first thing I'll look at is revenue for the company. And if you're not aware, it had a recent merger, Warner Brothers with Discovery, and that led to a surge in revenue. You look at revenues were growing steadily and then boom, just shot up higher at to 33.82 billion, and this combines the revenue of the two companies overall, which makes total revenue look better than it actually was. But at the same time that total revenue increase, look at what happened to total long-term debt for the after the merger, from 15 billion to 49 billion, a whopping 34 billion dollars in debt the company took on to consummate the merger. Right, you got to pay for the company you're acquiring in some way. Warner Brothers chose to borrow money in order to make this deal work. What that means for investors is that the new combined company is going to be burdened with close to $50 billion in debt. And with interest rates rising, that's going to generate significantly higher interest expenses on its bottom line. I wanted to look at the operating margin for the trailing 12 months and look at where the company was. I wanted to get a glimpse into where the company was before the combination to get an idea of where it could get back to, right? So before the combination, operating margins were hovering around 30%. And then, of course, digesting this acquisition is going to disrupt things for a little bit, and operating margin turned to negative 10.34% in the trailing 12 months. It remains to be seen if it can recover to its 30% average mark over the last 5 years before the acquisition. Uh, that is a question mark looming over this combination. If it can recover to those levels, then it will certainly be a more attractive investment. But that question mark right now is a risk. Can it get back there? Or if it doesn't, where can it recover to? Surely it's not going to remain negative operating margin after the combination. They made some cost cuts. They said they were focusing on the high performing content and focusing on quality over quantity, and so that's going to make an improvement in terms of the margins overall. A lot of question marks here, and that's usually not a good thing for investors. Investors do not like to see question marks, right? Because that just means it's more risky. And if you're looking at investing your money, taking money out of your pocket and putting it in an investment, you would like to see lower risk. I know I would like to see lower risk, right? When I'm parting with my money, I'd like to have as many assurities as possible. Of course, investing is never a guarantee, but the fewer uncertainties, the better. Otherwise, I can pick another company that has less uncertainty, that has less risk, and choose to invest in that one instead of this one. Another thing I wanted to look at is cash flow from operations to sales for the trailing 12 months. And this will help remove some of these restructuring charges, restructuring expenses as a result of the merger, and really show me where is the cash flow at, right? Because these restructuring charges could be non-cash expense that the company needs to account for on the income statement, but it's not necessarily costing cash flow to leave the company. And so looking at this, I can see that cash flow from operations is recovering, right? It jumped back up to 12.73%. It is positive, but it has been coming down since this merger, from a peak of about 32% down to now 12.73%. Again, can it can it recover back to this kind of trend line where it's not only the cash flow from operations is higher, but it's also improving? Now that remains to be seen. Finally, I wanted to look at the company's valuation to determine, is this stock expensive when looking at it on a forward price to earnings ratio. I know the stock price is up considerably for the year, but if its fundamental prospects also improved throughout that time, then it doesn't necessarily mean that the stock is more expensive. However, when I am looking at the forward price to earnings ratio, I do see that the stock has become considerably more expensive since the start of the year, and overall it's expensive, trading at a forward price to earnings ratio of 47.28. It started the year at a forward price to earnings ratio of less than 32, so it's gone up by about 50% in terms of valuation. Now this matters because it's what you're getting for the price that you're paying. Judging whether or not a stock is expensive is not just looking at the stock price and saying, oh, it's higher, it's expensive. That's not the only measure. You have to look inside at what you're getting, right? And some of you already know that I teach finance at university, and when I'm teaching my students, I use the example of a cereal box, right? You have two cereal boxes. One of the cereal boxes has 40 ounces of cereal inside and is selling at $5. The other cereal box has 10 ounces of cereal inside and is selling at $4. So you might, just looking on the surface, you might say, this cereal box is cheaper because it's $4 and this one is $5. But if you look at the contents, if you look inside, you're getting more cereal per ounce with purchasing the $5 box of cereal versus the $4 box of cereal. And that's why looking at metrics like the forward price to earnings ratio, like the price to free cash flow ratio, will inform you if a stock is expensive or not, because you see what you're getting for the price you're paying. If you're getting more for the price, so if you're getting more earnings per dollar, then the stock can be cheaper even though the absolute price is higher. Okay, even though the absolute price is higher, you can still say the stock is cheaper if you're getting more earnings, if you're getting a higher earnings per dollar spent. Okay, so looking at it that way, Warner Brothers Discovery is expensive at a forward price to earnings of 47.28. So to answer the question, is it too late to buy Warner Brothers Discovery stock right now? I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. I would say for now, yes, it is too late. The stock is too expensive right now for me to recommend this stock as a buy. I certainly would not buy it at this valuation, and I'm not an owner of this stock, nor would I consider owning this stock at this valuation, despite the fact that the company does have a lot of excellent uh, intellectual property with Game of Thrones, Harry Potter, and more. I would wait for the valuation to come down before jumping in here. All right, that's all I've got for this video. I truly appreciate your viewership. Thank you for watching. If you liked this video, I'm going to link to two other videos that I made that I think you're really going to like. So please go ahead and click on those, and I'll see you over there.